Hi folks, myself Raj. Welcome to our channel Code Shack. Thanks to everyone for watching our podcast show. And today is episode number 11. Our discussion topic is central banks and their pivotal point. So let's start. This week around the world, almost all central banks in major economies have reached a pivotal point. We see Switzerland became the first to cut interest rates, and the Bank of Japan for the first time after 17 years hiking interest rate. From Wednesday's meeting, we came to know that the Fed expected to cut rates three times this year, but we don't know when they will start. We can expect like almost 70% chance that the first rate cut may come at the Fed's June meeting, according to CME's Fed Watch Tool. Despite projection of stronger growth, lower unemployment, and slightly higher than expected core inflation, there are least chances for a slight increase in the central bank's long run rate forecast policy. As we see now, despite bumps in the inflation on growth, major central banks are on track to cut rates in coming months. But there will be consequences when rate cut will start. We know high interest rates are required to bring down inflation. Also, by slowing economic growth, we can lower inflation, and that may prompt rate cuts. But in today's scenario, we can see the economy has growth, inflation is still elevated, and the central bank is planning to do a rate cut. Result will be rise in inflation. We will see the stubborn inflation to remain for longer time period. The things to understand for the central bank, they have raised interest rate without setting off an unemployment crisis, which means that those rates are likely to remain high for some time. So more chances remain for prices to get accelerated again than compared with the threat of rapidly rising unemployment. We will see courtesy rate cuts this year to make the government, the market, and the investors happy. Technically speaking, it is not worth to cut rates for an economy that doesn't need lower rates. It will create the risk of bringing back inflation again. The continuous weight of Fed raises a lot of questions, like how much longer can consumers put off buying cars or homes as they wait out high interest rates? Will those paying off credit card debt get any relief on interest rate before the end of the year? Should savers lock in high interest rates before the bottom falls out on the CDs and high yield savings account? A reversal of the central bank policy would be sure to send those yields downward. In short, if making monetary policy is like a driving a car, then the car is one that has an unreliable speedometer, a foggy windshield, and a tendency to respond unpredictably and with a delay to the accelerator or the brake. Former Federal Reserve Chair Ben Bernanke said in 2004 while he was still a Fed governor. So that's everything for today. We want all our viewers to have a successful financial life. Hopefully, you guys like today's podcast. Please keep watching our podcast and keep sharing with your friends and family. We'll try to bring in more financial topic that will help you to save more from borrowings. Also, keep you one step ahead from your lenders. Have a wonderful rest of your week. See you again in our next episode. Thank you.